How is the central bank looking at this data? Let's bring in Ben Emons, founder and chief investment officer at FedWatch Advisors. Ben, it's good to have you. There is such a data vortex right now. How much stock should we put into the September report, the revisions from August, and net what that means for the Fed?
Hi, Leslie. Well, I felt it was a bullish report because, as you mentioned, this unemployment rate rising was really for the good reason. The report showed there was about 475,000 people coming back in the labor force. And then there were actually people that were long-term unemployed. There's actually few of them now long-term unemployed. There's one other sort of tidbit in that report. So I thought it's actually a really good report for the Fed to vindicate their view that this labor market may have had softening. And that's what those revisions from August show. But that is not falling off a cliff. And that's what this report actually shows. So the market actually responded to this, with rate cut probabilities dropping really sharply. Because, yes, the Fed doesn't have a reason here to cut rates immediately because there's no alarm on the labor market.
Yeah, odds now sitting around 40% chance of a cut in December. Do you think that's the right likelihood?
I think so. I mean, we talked about it previously that this Fed seems to be willing to stay on hold simply for the reason that they do feel that this labor market isn't deteriorating, but they're dealing with this inflation picture that's not cooperating in the direction that they want to. Beth Hammack was talking to Steve Leisman earlier today. She's making again a pretty strong case there, like we're dealing with elevated prices. And it's funny that that's against the Walmart earnings that show that there's not much pass-through coming to their earnings there. But overall, the inflation picture isn't really what the Fed wants it to be. So I think this probability will stay low. There's always a chance that they will go for it if anything changes, but I think they're on hold for December and go forward with January potentially.
Ben, Carter correctly has pointed out that the bond market's really nowhere over the last year and a half. We're waking up, it's 4.1%. We've been here before. I still think rates are going higher. I'm not suggesting I'm right, but what do you think's going on here in the bond market? I mean, this is probably best case scenario for the market. There's no bond volatility.
Yeah, that's right, Guy. I mean, you and I both shared this view that rates should be significantly higher. This is an economy that's so much like stimulus coming in over the course of next year with all this investment. You should actually see yields more closer to 5%. But I think what's happening is that there's some, hedging, some diversification against this equity market. And I picked that up from client conversations that bonds do look a little bit more attractive in that respect. And secondly, we don't have really any major surprises from the Fed in one way or the other, which kind of keep that volatility lower. And then it's about sort of the situation where who's going to be the next Fed chair, what they're going to do from there. And that, I think, does play a role because we saw from the comments from the president the other day, they really want to bring rates down. I think that sits in the market's mind since February to try to jawbone it down. And I think that's why you've seen some buying flows in bonds, even though yields should be higher because of a good economy.
I know you've studied what's going on in private credit quite closely. That was an area of concern for several Fed officials this week as well. We saw the Blue Owl merger get terminated amid concerns there, which is all playing into this broader market sentiment surrounding business development companies that have exposure to private credit, which have sold off. How do you think that all plays out?
Leslie, what you saw today was Lisa Cook with a speech out, putting a specific section on private credit, and then mentioning there that it's drawing their attention because it's grown so fast, so quickly, and there's now some stresses building there. And this Blue Owl's example is one other example of that although not falling apart, I don't think there's a financial contagion playing out here just yet, but they are getting the attention of the Fed. And I think the Fed will go from here with the SEC and the FSOC, which are bodies to start looking at private credit more specifically and saying, what can we do here in order to not let this morph into another subprime example? So I think that's what's playing out here. And this negative headline coming from that does affect markets because people don't like the opacity of private credit. This idea that money's tied in there, it's illiquid, and we actually don't know what the marks really are. That was an example, Blue Owl too. So this will stay a bit with us, and depends on what the Fed's really going to do as we go from here. Sounds like from Lisa Cook's speech that they're paying real attention to it, so we should really keep an eye on this.